That was one heck of a way to start February. We'll have to see if this next week is just as healthy for us, just as green, to see if we move on from just a bear market rally over to a full-on bull market. We'll take a technical analysis look at the S&P, and we'll also talk about ending that week with the consumer sentiment and what that means moving forward throughout the month of February into March, leading up to our summary of economic projections following the FOMC meeting on, I believe it's March 22nd and 23rd. And well, oh gosh, kind of feels exciting, doesn't it? I'm Dr. Stock, Doctor of Education. Let's get right into it. So here we're looking at the weekly chart for the S&P 500, and well, it's been kind of crazy. So looking at the weeks that we have here, one of the very first things that I notice is this interesting pattern building up right here, starting there at that high point, down to that low, back up to this high, and then an even lower low after that, and then not so high of a high low, and then finally finishing up about symmetric with what's before. What we call that is an inverse head and shoulders pattern, and that can be a very bullish signal for us. So remember, this is a weekly chart that we're looking at, so every candle stands for 1 week. So that doesn't tell us about the individual trading days that we have. However, if we can break the neckline, which the neckline is, let me go ahead and grab this here. I'm going to put a horizontal line on. The neckline is this line right here. And if we can firmly break resistance at that neckline, that could be a very, very good thing for us, that we complete the pattern and we see that bullish action take place in the markets, maybe for a little bit longer. It has been an extended rallying period in the S&P, in the Nasdaq, the markets overall, for several weeks now, pretty much the month of January into February. And everyone's wondering, when are we going to see that weakness come in, if at all? Does this turn into a full bull market run? We'll have to wait and see. So we'll see if this pattern completes or not. We'll see if the market takes a little bit of a rest. I think consumer sentiment coming out Friday can have a lot to do with that. And I also think that jobless claims on Thursday, when they come out, that could also be something that impacts this as well. We'll see if we continue to have tightness and a lot of strength in the labor market, or if it's something that starts to show a little bit of weakness. With that said, I wanted to show you something else with these charts. If I put the moving averages on the weekly chart and zoom out a little bit, you can see this faster acting 50-day simple moving average that we have dropping down. And so that could be an indicator that we're entering into an extended bearish trend, even beyond what we have right now. Now, the good thing is we're staying up above the 200-day. You can see it sort of acting as support so far, whereas before the 50-day was acting as, 50-week was acting as resistance for a while. However, in the last 2 weeks, we broke through that resistance on the 50-day, so now it gets to act as support. And so that's a really good thing for us, because if we didn't break through that, we could be nearing a death cross in the 50 in the S&P 500. So let's zoom out a little bit more so you can see what that looks like. So here's the pandemic. We don't necessarily get that death cross. It was such a steep drop so quickly, but then it rallied back up so fast that the moving averages, the 50-day or 50-week and 200-week, never really had a chance to even react to it. However, if we go all the way back to the 2008 financial crisis, look at this thing. Now we crossed down through the 50-day, so we did have the 200. My goodness, I keep saying day. This is a weekly chart, Dr. Stock. We broke down through and bounced off the 200-week, but then came back up and bounced off resistance on the 50-week, and that was enough to send us crashing on it down through all the way into the Great Recession, as we had it with the big market sell-off over time. Now, there's a lot of economic instability at that time, so there's a lot that is behind just the chart, just the technical analysis. And you could see the turning point that we had. So we had the double bottom there, but then the turning point in the 50-day, and then it starts turning back around. And even though it's not day, it's week, even though the 50-week simple moving average started turning back up, which is a good sign to have that positively sloped, this slower moving average that we have is still negatively sloped. But then we get this nice golden cross. And if I zoom back out so you can see the sort of action that we had, and even the chart being up above the moving averages is a good sign that we're in a full-on bull run. So we really want to see positive slope. So up with this upward movement with the moving averages and the chart and these candles also being above that, to continue to say that we're in that area. So we do not want to see that death cross play out. We don't want to see us cross back down below the 200-week simple moving average, which is this orange line that we have on the bottom here. So should we come back and retest support on the 50-week, and again, this is a weekly chart, 1 week at a time, if that remains support for us and we don't break through that and we keep moving upward from there, staying up above that is going to be a very bullish signal for us. So just keep that in mind. One more thing while I have you on the weekly charts, I do want to take us all the way back to the dot-com bubble, because when we go all the way back to the year 2000, 2001, you can see that break in the charts where we were pretty steadily above the 50-week and very steadily, very well above the 200-week. And the market was very frothy at that point in time, and you can see how it looked before then, that they were both running pretty much parallel to each other. And then this wide separation that we have here is that very rapid bullish action that was experienced over several years' time, and then nice steep drop falling off of that. And you can see once again when that 50-week turned around, we entered the golden cross. And even though it's a lagging indicator, look at the run that took place after it. Let me zoom in here. If the news continues to be good and that we don't get a lot of news of a large recession, then we might not see that death cross play out, which means we don't see that huge drop. We don't break down below the moving averages, which would be a very good thing for us. Even though this is technical trading, still when we look at what underlies these charts, a recession, a deep enough recession will break whatever sort of a bullish pattern we have, whatever trend we have, and it will send us lower. So that's something to keep in mind when we look at the weekly chart. If we don't get that sort of news, if we keep on getting good economic news and it turns out that the economy is stabilizing, then we don't really see that same drop that we had before. So stabilization, growth, good. Economic decline, bad. We don't want that. Let's go to the daily chart just real fast, because you can see this golden cross that we have here on the daily chart shaping up, but you can see this really steep peakiness that we get coming out of here. Now, I had the Bollinger Bands up last week. I believe it's on Thursday's video to talk about Friday probably being a red day for us. And it was kind of a crazy day because we went green for a little bit that day. As a matter of fact, we opened up somewhere around -1%. So being down in the S&P, I remember the NASDAQ was down about 2% at market open. I don't know exactly. Well, actually, I can. But being outside of the Bollinger Bands is something that we return back closer to the middle. So that would be outside 2 standard deviations from the mean. And this is the 20-day simple moving average that we have here. And you can see we've slowly worked our way back into that. Bollinger Bands being an indicator of price action, that having an unusually high value like we did here, or unusually low values like, let's go zoom out a little bit and go backwards. There we go. You can see here where we have this steep drop dropping outside to the downside, 2 standard deviations below the mean, and then flattening out and then heading back towards the mean again. So it is possible that we continue to settle a little bit or even trade sideways for a little bit throughout the week. And then consumer sentiment is the next thing that I want to share with you. In this tab, we have the survey of consumers from the University of Michigan, and the index for consumer sentiment is expected to come in at about 65, which wouldn't be much of a change from January. The same is okay. Up is great, down is bad. So we don't want to see any sort of trend reversal in consumer sentiment. We want to see that continue to grow over time if we're going to continue to see the market to be bullish. We also want to see growing a higher index rating for the current economic conditions, and then also index of consumer expectations. We want to see all of those numbers go up. That comes out Friday, February 10th at 10 a.m. So be on the lookout for that. If we get really, really good news from that for consumer sentiment, higher numbers, especially in all 3 categories, we are in really good shape. Now, they also do cover inflation expectations. So that's something that we also want to pay attention to. So when we look at year ahead of inflation expectations, and this is from January, we're looking forward to when we get coming out in February here, 3.9 or below. Excellent, because we want to see that expectation for inflation falling. And then also when we look at the long run inflation expectations, we also want to see this expectation continue to moderate as well. We want to see that either at 2.9, hopefully below 2.9. So depending on the sort of week that we get coming from the University of Michigan. That could take a very sideways week and turn it into a very green week, or it could take a sideways week. And if it comes in lower than expectation, that could turn it into a very red week. We're going to have to watch as that survey of consumer sentiment comes out from the University of Michigan. I think that that will be the big news event for the week, and it comes right at the end of the week. The other thing that we have is earnings. We have Chipotle reporting, we have Disney reporting. There's a bunch of other. Simon Property Group is also in there. If any of you like the REITs, those are also ones that I'll be checking out, and we'll see how they play out for us. Just a little bit of a longer term view, and then I'll give some final thoughts, and then I'll close this thing out. So moving on from here, consumer sentiment. Friday, watch for it. I think that's our big news event. CPI, we want to see how that's looking. Food and energy, I've mentioned before in some previous videos, maybe in some of the live streams with Stockmo, Stocks with Josh. If you haven't checked them out, please check out the two of them. They are incredible at what they do, and I'm very humbled to be able to live stream with them. So for the CPI, when we look at the overall CPI, food and energy might not be our friend. When we look at the core CPI, which excludes food and energy, and given their volatility, that could be something that's a little bit kinder to us. So if we come in at about 0.3 month over month, we're sort of okay. If we come in at 0.2 month over month, I think we're really good for a core CPI. If we come in lower than that, I think that we're still in really good shape. I don't see core moving that much, though. If I had to put a number on it, as for right now, and I'll share my research over at the Patreon, and I'll show you guys some of what I have spreadsheet wise. I'll share that here on YouTube. So if you do want to see me over at the Patreon, links down below. Come on over. Love to have you. Let me move on from that. So for core CPI, 0.2, 0.3 month over month, those would be very good for us, and that's also what I'd expect to see. However, moving on from there, if we have something higher than that 0.3 month over month, like 0.4, even though that's just one little tick up, I think that that's something that the market's not going to react very favorably to. And well, that could spell a little bit more red for us in the markets. So it would be nice to see a little bit of settling. We don't want to see too much of a run up because too much of a run up too quickly can lead to a really, really big fall all at once, and it can feel calamitous. And I don't want to see that happening. Moving on from there, looking further out, when we look at personal income and outlays, that's also something that's going to be very telling for us. The Fed minutes come out also in February, and reading what they have to say and really picking through the details, that can also be impactful for markets. And then that takes us into March for February CPI, also more consumer sentiment. We get the final rate report for that, by the way, at the end of February. So leading up to that Fed meeting in March, we have another CPI, that'd be February CPI. We also get another consumer sentiment. So we'll hope for really good consumer sentiment readings. Watch for those to come out, see if they come out higher, see if inflation expectations come out lower. Those would all be very good for us going into that March meeting for the Fed. PCE, CPI, we also want to watch those going into that Fed meeting in March to really get a beat on what the direction of the economy is, and also what the direction of the quantitative tightening cycle is, and getting a better grasp on when exactly we will reach that moment for Fed pause and possibly even into the next quantitative easing cycle. As far as recession goes, honestly, I think Q1, Q2 could be it for us, possibly as far as Q3. If I had to put it anywhere, I'd say it's in those 3 quarters of 2023. And I think by the end of Q3 2023, we'll start to see some more dovishness from the Fed come out. And it would be really, really nice to start to see some quantitative easing. If we see that in 2023, we could end the year on a very, very strong note. So we'll keep our fingers crossed. We'll watch and see what happens. Thank you guys for watching this video. If you want to hear more of what I have to say or talk with me over my Discord, you can check out my Patreon. As I perform my research and as I get things typed out and everything, I'll share those things out. I also have Patreon exclusive videos that I've started putting out over there. I'd absolutely love to have you. So again, check out that link down in the description. Thank you so much for being here. Thank you for sticking around for this video. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.